Hi everyone, I'm John Zaller, CIO of MAI Capital, here with the latest edition of the MAI Market Update. This month, we'll be taking a look at the unique challenge facing balanced investors in 2022 and what it means for portfolio positioning going forward. While the equity market declines in 2022 have certainly been front and center in our minds for most of the year, with the S&P 500 falling into bear market territory in late June, followed by a recovery of a good portion of the losses in the months of July and August. As we've often discussed, equity market corrections like we've seen this year are far from abnormal when looking back at intra-year corrections over the past few decades. But what has been abnormal is that bonds have declined almost as much as stocks and have provided almost no diversification benefit in a period of time when balanced investors needed it most. As shown in the chart on your screen of annual stock and bond market returns going back to 1990, where the dark gray bars represent the S&P 500 and the gold bars represent the Bloomberg US Aggregate Bond Index, there hasn't been a single year where the US stock market and US bond market have declined in the same year. Unfortunately, 2022 is shaping up to be a year that bucks that trend, with the Bloomberg US Aggregate down 10% and S&P 500 down 14% on a year-to-date basis through August 26th. For a balanced investor, with the majority of their portfolio in stocks and bonds, this dynamic has made 2022 that much more frustrating. We believe the main driver of this downside correlation between stocks and bonds has been the onset of the highest inflation rate in the United States that we've seen in over 40 years. Insofar as inflation has caused an abrupt tightening of monetary policy by the Fed and a general repricing of financial assets to adjust for a higher interest rate regime. Headline inflation has been running above 8% for most of this year, driven by, in our view, the unprecedented fiscal and monetary stimulus during the COVID pandemic, supply chain and labor market shortages, as well as Russia's invasion of Ukraine this year. Whether inflation comes down quickly or stays higher for longer will play a big determining factor in whether stocks and bonds can resume their typical relationship as diversifying assets. As we look at the year-over-year changes in each of the components of the Consumer Price Index, it is clear that commodity prices and supply chain constraints are driving a big part of the inflation story, with energy, food, and new vehicles showing the most severe price increases. On this front, we've been encouraged to see gas prices starting to ease nationwide, and shipping costs and delivery times improving as well. On the other hand, wage pressures have continued to build through the summer, even as more and more companies are freezing hiring plans and beginning to announce layoffs. Wage growth, which is currently running over 5% year over year, will be top of mind for the Fed in their rate hike decisions in the months ahead. Whether the recent surge in inflation dissipates quickly or slowly, we do expect that ultimately the Fed will win the battle against inflation, which in our view would cause the recent heightened correlation between stocks and bonds to return to a more typical relationship and provide balanced investors with the diversification benefit that they've been accustomed to. In the meantime, we do expect markets to remain choppy as the risk of the Fed over-tightening monetary policy and inducing a recession remains fairly high over the next 12 to 18 months. In periods of high uncertainty like we're facing today, it is so critical for investors to maintain a long-term perspective, to stay focused on your full time horizon, and to stick with the long-term allocation that we've constructed of equities, fixed income, and alternatives that we believe can deliver on your goals over the long run. Please know that at MAI we are hard at work to identify ways to tilt your portfolio to what we see as the best risk-adjusted return opportunities in the market. And we would also encourage you, as always, to reach out to your wealth manager at any time to discuss your portfolio in more detail. Thanks so much for listening, and we'll see you next time.